I don't want to be in places like that. I want to be in places where if this part of the economy gets hit, I still have a solid base over here, right? So we try to mitigate all of the risk. Can't eliminate it, but you try to mitigate it as much as possible.
What's interesting is like after 2008, so many people ended up in foreclosure. I imagine the rental markets might have been more demand for people to rent because they couldn't stay and service a mortgage anymore.
Absolutely, rents actually increased. So it's funny because if you bought on solid fundamentals in 2008, the month before the crash, so you had all of your numbers dialed in, everything was dialed in. What actually happened with your property is as it lost value, which unless you sell it, the house doesn't get its feelings hurt because it lost value, right? So what actually happened with that is your cash flow rose because rents increased and vacancy rates decreased, right? So it was a perfect storm. At the same time, our mortgage rates stayed and went down, stayed at historic lows and then went down. So you could actually refinance and you could have lower interest rates and then lock them for 30 years, which in effect shorts the dollar long term, right?
Yeah, it's very interesting. So do you rely a lot, though, on that equity in the current properties to purchase new ones? Or
Nope, not at all.
How do you go about that?
Not at all. So I never buy and I never encourage other people to buy properties based on appreciation. Appreciation is a gift. And when the market gives you the gift, you harvest the gift and you go buy more properties, right? But you buy properties on fundamentals. You buy them like you would a business. Nobody goes in and buys a business because they think that they're going to make it better. They buy the business on the profit and loss statement. So you go into the business, you look at the P&L, and then you'll get a multiple of whatever that business produces. It's no different with real estate. You've got to go in it and you've got to look at it. Usually you have to build your own P&L on it, which is basically that pro forma. You've got to know what all the costs are, and then you've got to understand what the underlying soft costs are. And when you do that, you buy it based on pretty good fundamentals. There's always things that could happen there's always risk, right? But you can mitigate the majority of that risk. And then if the property loses value, it loses value. You're still producing a positive cash flow, which is giving you, it should give you either high single digit or double digit cash on cash returns. Someone is paying your mortgage for you. Which is a return because there's principal reduction happening there. That's usually between 3 and 5% a year, which is better than most people get long term in their funds, right? Just by itself.
Say the principal pay down is usually 3 to 5% a year. Yeah, and
it's 3 to 5% on the invested capital. So that's the other thing, right? Is you don't have to pay cash. You can leverage real estate. So you have to figure your returns on what you put into the property, not on what the property's worth.
So what market are you most focused in right now?
I'm focused in several, actually, but they're all in the Midwest.
Okay.
So before the market tanked, in 2006 through 2008, we started to pull away from the high appreciating markets because as they out appreciated the rent, the numbers didn't work anymore. So we pulled into the Midwest where it's safe, you can still get cash flows, and you can do that pretty much any time. And then in after 2008, when everything crashed, we went back. We went back into Florida, back into Phoenix, and actually we didn't go into Vegas because of the economic things that I had talked about. We went into Boise, which was a very similar market, except for it had a stronger economic footing. And we bought properties from 2009 to 2012, 13, depending on the market, and then same thing happened. All of those markets have appreciated like crazy, and then by 2014, we were out of all of them, and we went right back into the Midwest.
Out of meaning you sold the houses?
No, we just stopped selling houses. So we stopped buying there, and we stopped selling to our clients there because the fundamentals didn't work anymore. The numbers didn't work anymore. But we held those properties because we weren't at the top of the market yet.
So when you're saying clients, so you're basically saying, what are you selling to clients when you say we're selling to clients? This is
same thing I buy.
Okay.
So single family, duplex, fourplex for entry level people who don't have a big portfolio yet, so they can start to understand how this works. And then larger multifamily properties for folks who have some experience and have assets.